Hello and welcome back. I'm your host, Dr. B, Accounting 201. This is Inventories. Inventories. In the last chapter, we talked about retailer businesses, retail formation of businesses. We talked a lot about how sales work for retailers. Now, we're going to talk about inventory. We're going to talk about how do we value inventory, how do we pay for inventory, and what are the costs of inventory. Okay, inventory. Inventory, as you know, is what the retailer sells to the customers. That's inventory. In business, we need to make sure that we protect our inventory from theft or from damage. So how do we do that? We'll keep it in this back room. We'll keep it locked up. We'll monitor our inventory. We'll safeguard it, right? And then we also need to report our inventory on the financial statements. We report inventory on the income statement as cost of goods sold, and we report inventory on the balance sheet as inventory, which is an
I
asset
have a
account.
question.
Yes, please.
So, from the first slide, when you have to report the inventory on the balance sheet, is that the same way how you report it if a theft, like if someone comes in the store and they steal, you have to go check to see what inventory that they stole off the shelf, like the product wise?
Regina, great question. So yes. So the way it works is our inventory is reported as a current asset on the balance sheet. And that's the inventory that we have on hand. If someone were to take it or it got damaged, we would reduce that inventory that we have on hand because we don't have that on hand anymore. And to do that, we would debit cost of goods sold and credit inventory. Good question. Yep, that's correct. Regina, did that help to answer your question?
Yes, I just always wanted to know that because I work at CVS, and I know the store that I specifically work at, we do have theft in that area. So I always
Sure.
wanted to know how my supervisors and managers like would credit that if something gets stolen, or if they don't know exactly what is stolen, how would they be able to put that down and say the inventory got messed up or anything?
Right. Exactly. Yeah, good question. Yeah, unfortunately that is a part of retail. That's part of the business. Yeah. Very good. Thank you.
You're welcome.
Okay, so how do we control inventory through a couple of documents? We have what's called a purchase order, a receiving report, and a vendor's invoice. When the company purchases inventory, we issue what we call a purchase order. It's an order that we send to our suppliers, and we say, hey, we'd like to order this particular inventory. That's a purchase order. Then we have this thing called a receiving report. It's also known as a packing slip. Receiving report, also known as a packing slip. It comes with the boxes that we ordered, and it has a list of exactly what's in that box. And we check it off and make sure that it's actually there. And then we have a vendor's invoice. That's the bill, right, for the purchase of our inventory. So again, purchase order authorizes the purchase for the inventory from a vendor. Receiving report, that's the packing slip, comes with our order. We match everything to what we received, and we record everything on the inventory ledger. So again, we debit inventory and we credit either cash or accounts receivable, depending on how we're paying for it, to increase our inventory. Physical inventory is the inventory that I count, okay? Inventory that I count. So at the end of every year, or at halfway through the year, or at the end of every month, however the business does it, they'll go through the store and they'll go, okay, on my sheet it says I have 10 red shirts. Do I have 10 red shirts? And they'll go 1, 2, 3, 4, 5, 6, 7, 8. Oh, I don't have 2, but write down 8. Okay, and then they'll have to make an adjustment for the 2 that are missing. That's called a physical inventory. The quantity of the inventory on hand is determined that way. The cost of the inventory is assigned to the financial statements. Most companies assign cost of inventory using the inventory cost flow assumptions. Okay, here we go. We're going to talk about 3 methods of costing for inventory. The first one is called the first in, first out method. The second one is called the last in, first out method. And the third is called weighted average. In the first in, first out method, this is the order in which the costs were incurred. Okay, here's an example. Let's say I am a grocery store and I sell oranges at my grocery store. And I bought 100 oranges from my supplier at 1 penny per orange. Okay, so a penny per orange, 100 oranges, $1. So I record $1 when I receive those oranges. Then, of course, I'm going to sell through them, and I'm going to order some more oranges. I'm going to order another 100 oranges, and this time my supplier comes and says, hey, you know what? The orange price went up. It's 2 cents per orange now. Okay, so $2. And then I order again later on more oranges, and they say, oh, it's back down to a penny. Okay, $1, right? So first in, first out. Think of the physical flow. At a grocery store, they sell the inventory that they got in first, right? So here's an example. You go to the grocery store and you notice that in the front of the shelf is the older inventory. That's what they want to try to sell first. First in, first out. The reason for that is because, and especially in a grocery store, their inventory is perishable. Perishable, meaning it expires. Yep. So first in, first out. Second one is last in, first out. Last in, first out is the reverse order. The last one is the one I'm going to sell first. That's last in, first out. An example company that uses this would be a retailer like Macy's, Amazon, Best Buy. The reason for this is because those goods are not perishable. They don't expire, right? A TV doesn't expire. Headphones don't expire. A t-shirt does not expire. So because they don't expire, they use the last in, first out method. And then we have weighted average. This is where we take the average of all of our purchases together.
Hey,
Yes.
in retail, with the last in, first out, is another reason is because, like you said, Best Buy, the last one they got in might be the latest model, so it might be the first model that they promote or the first one that goes out, which is normally the highest one.
That's correct. Yeah, absolutely. That's another good example of for the reason why they might use last in, first out. Very good, David. Yeah. Okay. Let's work through some examples. Okay. Let's say our company purchased, what the hell are we purchasing? Let's say we're purchasing, I don't know, a coffee mug. Let's say we sell coffee mugs, high-end ones, the real fancy kind. Okay, we sell coffee mugs. And we purchase the same exact mug and we sell the same exact mug all the time. So on May 10th, I purchased a coffee mug for $9. I sold it. May 18th, I purchased that same coffee mug again from my same supplier. And then they said, hey, it's $13. So, okay, great. Then I purchased it again on May 24th for $14. So I have 3 coffee mugs now, and it cost me a total of $36. If I was using the average cost, I would simply take my $36 and divide by 3, giving me an average cost per unit of $12. Okay. Now, we're going to sell some of our coffee mugs. Let's assume that we sold one of our coffee mugs on May 30th for $20. Oh, that's nice. Depending on which unit was sold, the gross profit will be different. It'll range from $11 to $6. Here's how it works. First in, first out is that this is that first column that you see here, May 10th. May 10th. First in, first out. Now remember, I bought that first coffee mug for $9 on May 10th. And I sold it on May 10th, we'll say. Also, I sold it for $20. It cost me $9. That gives me a gross profit of $11. My ending inventory is $27. How did I get to $27 for my ending inventory, you might be asking? Well, I sold that first one. It cost me $9. That means I have 2 more left from May 18th and May 24th of $13 and $14. So 13 plus 14 is 27. Okay, the second one. Let's say I sold that second one that I bought on May 18th for $20. Remember, that second one cost me $13 when I bought it on May 18th. So $20 minus 13 is 7. It's gross profit. Ending inventory is 23. How 23? My first purchase was 9. My last purchase was 14. It's means a $23 ending inventory for May 18th. Then on May 24th, I sold that one, last in, first out. Okay, $20. I sold it for $20. It cost me $14 to buy that mug. Gives me a gross profit of 6. My ending inventory is $22. 9 plus 13. Make sense? Good so far? These are cost flow assumptions. Thank you, Erica.
Professor.
Yes, please. Regina.
I said, can you review that one more time, please?
Oh, Lynette. Yes, Lynette, absolutely. Okay.
And then I have one more question before. When you said that in your previous example, you said that you bought the mug. Let's say you bought the mug for $9.
Yes.
I bought 10 mugs and I only sold 1. But then when I go back to that manufacturer, those same mugs are now $13. Mm-hmm. Is it ethical? Now, remind you, keep in mind, I still have inventory for $9. So I think that's profit I could make if I'm just selling all of them for $13. For that markup, for the profit of the $13. Do you understand, or do I have to keep that?
Yeah, I do. So yes, I hear you, Lynette.
That's a big profit I can make if I'm now starting to sell it for markup.
Exactly, and so Lynette, what happens is that also helps companies determine in the order of which they're going to sell things by using either first in, first out, last in, first out, or average cost. So the way it works is the reason why you see that the cost to us is different each time is because the market price changes, right? The market price changes regularly. I bought that first coffee mug for $9. I bought the second one for $13. The last one for $14.
Yes, I was about to ask you, Professor, why is it the price, like, what making it go up? Like,
Yeah. Yep. So it's market price, right? It's whatever my supplier says it is, right?
Okay.
It's like I first bought it for $9, and he goes, "Hey, you know what? I don't have very many left, so it's going to cost you $13 for that second one." Then I place another order with him, and he goes, "Hey, you know what? I really don't have much left, so now the price is $14." So okay.
Okay.
It's market price, yeah. And so because we know in business that the price is not going to always be the same. Yeah, it's going to change over time. And so that's why 9, 13, 14. Now, what happens is that I'm going to sell these coffee mugs, but I'm going to just sell them for $20, right? My list price is $20. So ideally, I'm going to want to sell that first one to get the most profit, right? That's the idea. I'm going to sell that first one to get the most profit. So $20 minus 9 is 11. You can see that that $11 is higher than the other two mugs. So I sell it for I sell it for 20. Gross profit's 11. Ending inventory is 27. The inventory is going to be higher than the other two, right? Because remember, I just sold the one I paid the least for. Does it make more sense? Yeah? Okay. It'll make more sense as we go along, too, because we're going to see some other examples. Okay, so under specific identification cost flow method, which is the fourth method we don't really talk about, the unit sold it at a specific price or purchased at a specific price, and ending inventory is the difference remaining on hand. We're going to focus though on first in, first out, last in, first out, and average cost. First in, first out, the purchase price is assumed to be sold, and the ending inventory is made up of the most recent purchases. Last in, first out, we assume that we're going to sell the last one first, right? And weighted average, we take them all in average. So here's how it looks. Okay, I like this graphical representation because it's the easiest way to compare the situation. So on May 10th, I purchased a coffee mug for $9, May 18th for $13, May 24th for $14. Using the first in, first out method, I sold it for $20. Cost of goods sold was $9 because that was the first one that I purchased and the first one that I sold. Gives me gross profit of 11. So far, I like first in, first out because it gives me a higher gross profit. That's nice. But my ending inventory is $27 because on May 18th and May 24th, I purchased $13 and $14 respectively. 13 plus 14 is 27. Now let's compare that same process to the last in, first out method. $20 is still my sales price. My cost of goods sold is now 14. Why is it 14? Because the last one that I purchased cost me $14. So 20 minus 14 is 6. $6 gross profit. That's the lowest out of the three methods. My ending inventory is $22. My first one I purchased was 9. The second one was 13. That equals 22. Using the weighted average cost, my cost of goods sold is $12. How did we figure that out? We took all three purchases, 9 plus 13 plus 14, and we divided by 3 to get the average, right? The average cost is $12. So my sales is 20, cost of goods sold is 12. How's it 12? You add all three purchases, divide by 3. 20 minus 12 is gross profit $8. My ending inventory is 24. How did I get 24? It's $12 times the 2 that are left. Does it make more sense? Hopefully this brings more clarity to the difference between the three methods. Good so far. Okay. All right. Here's an example. I have a product. It's called item number 127B. I don't know what it is. All right. I have a product that I sell. It's item 127B. And this item that I sell, of course, I purchase and then I sell it. Purchase and sell, purchase and sell. On January 1st, I purchased 1,000 units of this item 127B. Cost me $20. I sold later in the month on January 4th. I sold 700 units at $30 per unit. That gives me a gross profit of $10, right? 30 minus 20 is 10. Then I purchased some more. I purchased 500 more at $22.40. The cost went up. And I sold some more. I sold 360 units at $30. And then I sold some more, 240 at $30. And then I purchased some more, another 600, $23.30. It's very similar to our earlier example. But what this shows us is it shows us the perpetual inventory system. Yeah.
Oh, okay, that's the date. Okay, I see the date.
Yep, the date, exactly.
January 4th.
Yep, January 1st, January 4th, January 10th, January 22nd, 28th, 30th.
It shows and right there, the blank spots under the 20, it's supposed to be like what you made off for the 700 units at $30, correct?
No, it's because this last column here, it says cost. That's what it costs us.
Oh, okay.
Yeah. The word's blank. It's actually where I'm selling it, so it doesn't cost us to sell. Well, I mean, it does cost us to sell.
That'll pop up on another sheet.
Yep, it'll show up. It'll show up under cost of goods sold, exactly.
Right. Okay.
And what this sheet shows us is it shows us for this particular item the purchases and sales for that item. Yeah, good question, David. So using the first in, first out method, I'm going to sell the ones that I purchased first. That's what the physical flow is. I got it in first, and then I sold it first. It's the physical flow. And like I said before, oftentimes grocery stores use this because the products are perishable. So here's a nice graphical representation of that same item 127B that we talked about earlier. This is using the first in, first out method. January 1st, I purchased 1,000 of them at $20 a piece. That's $20,000 total cost. On January 4th, what happened? I sold 700 of those units for, what was it, $30, I think? Yeah. That on January 4th, we see I sold $21,000 worth. I sold 700 units. 21,000 debit accounts receivable, credit to sales. And of course, anytime you sell something, you have to debit cost of goods sold and credit inventory. And this just is a nice graphical representation of the first in, first out method for this particular item. Now we see a couple of things here. The total cost. At the end of the month, we total up our total cost of goods sold, right, for that item. We realized that the total cost of goods sold for that item was $26,720. And then we also see the total cost. The total cost of that inventory is $18,460 for that item. Fun stuff, right? And then the ending inventory balances. This is exactly what I was showing you, that $18,460. How do we get there? Well, on January 10th, I made a purchase. On January 30th, I also made a purchase. I purchased 200 and 600 respectively, total 800 units. Unit cost was $22.40 on January 10th and $23.30 on January 30th. So that's first in, first out. What about last in, first out? So as we said earlier, the last in, first out method is the last purchase that I made and I got it in, I sold that one first. Okay. An example of companies that use this would be like Best Buy or Walmart or Macy's or whatever, because their products don't expire. The reason why some businesses will use the last in, first out method is because they usually show a higher cost of inventory than the other methods. And with a higher cost of inventory, businesses like that because a higher carrying cost means the less that they have to pay in taxes. It's a little inside information on that one, yeah? Okay, so using the last in, first out method, on January 30th, we purchased 600 units, right? So we're going to sell that 600 units first. So using the last in, first out method, we find our total cost of goods sold is $27,200, and our ending inventory is $17,980. How we got the $17,980? Remember, we sold the last one first. Okay, and this shows us the sheet for the purchases and sales of the units for the beginning inventory. January 1, 40 units at $5. We sold 30 units. January 18th, we purchased another 70 units at $7, and we sold another 36. The company uses the perpetual inventory system. So we figure out what is first in, first out, what is last in, first out. So using that data, this one's for first in, first out. We find that our total cost of goods sold is $382, and our ending inventory is $308. Using the last in, first out, we find our cost of goods sold is $402, and our ending inventory is $288. Typically, what businesses need to do is they should compare first in, first out, last in, first out, and weighted average to figure out which method is the best for the company to use based off of the type of the company, based off of the type of the company that it is, and also based on the associated tax benefits. So again, using weighted average, we take all of the purchases together, the total cost, divide by the number of purchases, give us the average. In the periodic inventory system, only revenue is recorded at each time sales made. There's no, and we record cost of goods sold at the end. Just another example. I like this one. This obviously from our earlier example. This kind of shows a nice graphical representation of the flow, right? For first in, first out, January 1, 1,000 units, 20. Available for sales, 20,000. We sold 1,000 units at $20. Cost of goods sold, 20,000. Any question? We're good? Okay. That's why I like this nice flow chart. Last in, first out, we would assume that there's 800 units on hand because, again, with last in, first out, we sell that last purchase first. And that's what this flow looks like. Weighted average, you take to figure out the weighted average unit cost, you take the total cost of units available for sale and divide by the units available for sale. In our example, total average cost of units available for sale was $45,180. Units available for sale was 2,100. That gives us a total weighted average unit cost of $21.51 per unit. And here's what that flow looks like. So when you compare the three methods to each other, we compare them. When we compare the results, we'll look at the difference between the cost of goods sold, gross profit, net income, and ending inventory. Based off of these figures, it gives us a better idea of which method will be best for our company. Did you have a question? Just please make sure that you're on mute, okay? Unless you have a question. Lynette?
She wants to know what time would work for you on Tuesday.
Please make sure you're on mute.
Let me make sure I'm on mute.
You're not. I can hear you.
I'm not.
Yep. Go ahead and mute your phone there.
And the doctor team wouldn't be able to do any time between.
Please mute your phone. Thank you. Okay, you're good now. Thank you. Okay, so this represents the changes based off of the difference between cost of goods. Based off of the first in first out method and the last in first out method. It shows the what happens to the price and what happens to cost. It's just a nice representation of difference between each one. Let's see. We talked about that. Financial statements. Okay. As you know, inventory is recorded as a current asset on the balance sheet. When we sell inventory, we record it as a cost of goods sold on the income statement, and we take it out of inventory on the balance sheet. So the cost of goods sold represents the cost of valuing the inventory. Cost of replacing items is when we record the cost. Inventory can be sold at normal prices due to imperfections, style changes, spoilage, damage, obsolescence, and other causes. What typically happens is that if there's something wrong with it, or there's something wrong with the style, or it's spoiled, damaged, obsolete, whatever, we'll typically either sell it at a very reduced price, or we'll throw it out, or we'll send it back to the supplier. There's one last method I want to talk about. It's called the lower cost of or market. Lower cost of market is when we use whichever is lower. Whether it's the market price, we use whatever the market price is. We do that by taking the estimated selling price minus the direct cost of disposal. Selling price minus cost of disposal. Don't need to worry too much about it. That's why I'm going through a little quicker. Lower cost of market is applied in one of three ways. You take the cost, the market price, and any declines for each item in inventory, major class of inventory, and the total inventory as a whole. Let's see example. Okay, inventory on the balance sheet. Again, the inventory on the balance sheet, the cost of that inventory is recorded using either first in, first out, last in, first out, or the weighted average, or sometimes cost of market, but usually not. And here's where it is on the balance sheet. It's current asset, merchandise, inventory, or just called inventory. Now, if there's errors on the financial statements, it's usually a result of physical inventory count was incorrect, the wrong cost was assigned, something happened in transit. All of these types of things will cause errors on the financial statement. Don't need to worry too much about that. Those are the types of impacts. Sorry, I'm going through a little fast. Retailer the business should be kept, they should always have enough inventory on hand to meet customers' needs. Too much inventory means that we have cash tied up in inventory that we could use for something else. A classic example of that is Bed Bath & Beyond. They seem to always have too much inventory, which means they tied up too much of their cash that they could have used for operations. Excess inventory increases your expenses and increases property taxes. If you have too much inventory, it also increases the risk of loss. To make decisions, managers will often use a couple of ratios. One of these ratios is called the inventory turnover ratio. The inventory turnover ratio, we take the cost of goods sold and we divide by the average inventory. Another ratio that managers will use to understand if they have enough inventory on hand is called the number of days sales inventory. This tells us how long we've had something in our inventory account. To take that, we take the average inventory divided by the average daily cost of goods sold. And that is the end of our inventory chapter. Are there any comments, questions, or concerns for inventory that you have at this time?
Professor, you are going to post these recordings, correct?
I'm sorry, David, what was that?
You are going to post the recordings too?
Of course, yeah, I always do.
Right.
Absolutely.
We went through it a little fast. I had a few questions, but I didn't want to hold us up.
That's okay. Yeah, absolutely. And David, as always, if you have any other questions, feel free to contact me. I'm here for you. Yeah, very good.
All right.
Cool. Any other comments, questions, concerns?
Professor?
Yes, Dante.
I I just emailed you earlier about Cengage, so can you just give it a look after class, please?
I sure will, and I'll take care of it for you. Absolutely.
Thank you.
My pleasure. Any other comments, questions, concerns? We're okay? All right. Now, as a reminder, all of your work is supposed to be done on time. Okay? Some of you missed a few assignments from earlier. You cannot make up discussions. Discussions, if you missed it, you earn 0 points for it. You can't make that up. But if you missed a quiz by a day or so that was due yesterday, or a homework assignment that was due yesterday, or I'm sorry, 2 days ago, make sure you get that done, okay? After a while, I'm just going to start entering zeros in the grade book, which I've already started to do, and I'm not going to allow you to make it up late, okay? Every assignment, every homework assignment, every quiz, every discussion board, it's worth 5% of your total grade. Do not miss it. Do not be late. Sometimes you might have issues with a textbook. Okay, I understand that. No problem. As long as I know about it, it's okay. I'll work with you. But please do not be late. There's too much work to be done in this class for you to fall behind, especially knowing that the midterm exam is next week. It's at the end of next week. So please make sure if you're missing something, make sure you get it in.
Professor, I have a question.
Yes, please.
Yeah, the homeworks is only on Cengage or the modules and the modules.
The whole you have to access it through the modules. Okay.
So if I click homework on the modules and it opens, that means I have access for the Cengage.
That's correct.
Oh,
yep.
Okay.
You can only access Cengage through the modules. You cannot access it through any other website. Has to be done through the modules. Good question. Absolutely. Yep.
Thank you.
You're welcome.
That's the only homework we have, and only in the modules, right?
That's correct. Everything is on Blackboard. As long as you follow the modules exactly as they're written, you'll be able to complete your assignments through there. Mm-hmm.
So question.
You're welcome.
We have discussion board this week?
I'm sorry, go ahead, Richard.
So before I ask you what's due for this week, so I have other courses which I use for Cengage, and
Mhm.
I access directly to the platform. So if I access your course through the platform, is that
No.
any problem?
Yep,
Because
it
I'm doing
won't
very well.
work. It won't work. Yep, you have to access it through Blackboard. Do not try to access it through the platform because it won't work.
But okay, but it's working for me. Just wanted to make sure.
Okay, well it's fine if it does, but in most cases it doesn't. That's why I was concerned. Yep.
Okay, so I'll just make sure to access it through Blackboard next
Through
time.
Blackboard. Yep, exactly. Yeah,
Thanks.
and the reason for that, Richard, is because sometimes it'll make an error in the grade book. Yep.
Okay.
Yeah.
Didn't know that. Thanks.
Sure. Yeah.
So the next assignment is the chapter
Chapter 6. So we're in week 3. Okay.
chapter 5 quiz and chapter 6 homework.
You got it. Chapter 5 quiz, chapter 6 homework, and both of those are due by Sunday night, as it always is. Absolutely. So again, as long as you're in Blackboard all the time and you're following the modules step by step by step, you're clicking on each one, you're good to go. You know, that's what'll keep you in order. Yeah. So, for example, we're in week 3 right now. If you click on chapter 5, it opens up. You're going to see what it is that you're going to learn. There's a couple of short videos. It'll say what you need to do. Read chapter 5. Take chapter 5 quiz. Then you just click next, or you come back right here. Chapter 5 PowerPoint, chapter 5 quiz. And then you go into chapter 6. Chapter 6 opens up. Learning objectives, a couple of short videos. You know, just kind of recaps things. These videos are super short. They're like 2-3 minutes a piece. You know, it makes things a little easier. Tells you exactly what you need to do. Read chapter 6 read chapter 6 in the book. Complete chapter 6 homework assignment. And all you do is you click next, or you come back, and then click chapter 6 PowerPoint, and then click chapter 6 homework. When you click on chapter 6 homework, it'll take you to Cengage through Blackboard. That's the only way you can access the homework is through Blackboard. So everything's in Blackboard. Just follow everything as it is.
Are we good to go, Professor?
You're good to go.
All right.
I appreciate all of you. I hope you all stay safe, wash your hands, all that good stuff. If you have any questions, you need any help, please reach out to me. I'm here for you. You can schedule office hours with me. You can call me. You can email me. I'm here for you, okay? Now, you all take care.
Thank you.
Thank you. I appreciate all of you.
Professor.
Take care now.
Have a good one, Professor.
You too. Thank you so much.